90% of the stuff on here is a tax deduction. And most of these tax hacks are ways that you can deduct more things, meaning a normal expense, an expense in your business, an expense that is probably already, pretty relative to most humans as they're going about their day-to-day life. We're going to find a way to deduct those things so that we're saving 30, 40, 50 cents for every dollar in taxes. My name is Nick Huber. I'm a real estate syndicator, small business owner. Mitchell is my CPA and friend of mine out of Houston, Texas. Mitchell, you specialize in tax work, planning, consulting for high net worth business owners and real estate investors.
That's right. Yep. So CPA, financial planner in Houston, and run a small practice and work with you on a couple of things.
Yep. Let's dive right in. So we have small business owners that are listening to this, watching this, and you've tweeted several times that the tax code in the United States favors people who own assets, whether it be real estate or small business, and it does not favor a W-2 employee. What do you mean by that?
The quote is, owning a small business is the best tax deal in America. So I used to have a job. I was a W-2 employee, great, stable, got the same amount every 2 weeks. But when I drove my car to work and worked a full day and came home, I earned a paycheck. They took my taxes out. And then when I paid my cell phone bill and when I put gas in my car and, when I went to a work conference that my employer didn't pay for, that was all post-tax. So it was earn the money, pay the tax, and then spend everything else. And what going into small business for yourself does is you earn the money, you pay all the expenses that it takes to make the money, and then you pay for all the fun stuff we're about to talk about right now. And then you pay the tax man. And if you do it right, you just kind of defer that out as long as you can forever.
I love it. So there's a difference that we'll start out by discussing. There's a tax deduction and there's a tax credit. A tax deduction means that your taxable income decreases by $1. And your tax bracket, you might only be in a 30, 40, 50% tax bracket. So $1 deduction is worth about 30, 40, 50 cents of tax savings. A tax credit is a direct it's a coupon that basically saves you from having to pay $1 tax. Those are 1-to-1. 90% of the stuff on here is a tax deduction. And most of these tax hacks are ways that you can deduct more things, meaning a normal expense, an expense in your business, an expense that is probably already, pretty relative to most humans as they're going about their day-to-day life. We're going to find a way to deduct those things so that we're saving 30, 40, 50 cents for every dollar in taxes. Let's just jump right in, start off with number one, get this thing kicked off. Mitchell, you have written down an S Corp, and the idea behind that is that you can save employment taxes by setting up basically an LLC that you run, work through under certain guidelines. Let's talk a little bit more about that.
Yeah. So, the first thing is everyone says, when should I start an LLC? And, there's nothing magical about an LLC. It doesn't mean you can take expenses that you couldn't take anymore. You can't deduct your kids' haircuts because you have an LLC, despite what TikTok might tell you. But, setting up business structures and setting up the ones you need when you need them can save you a ton of money. And an S Corp is the first thing I set up. In 2014, I was still working at my job and I knew I was going to leave and I was selling a little bit of side work. And I said, you know what, I'm going to have to know how to do this for my clients anyway. So I'm going to start with me as the number one guinea pig. And I still have that S Corp today, but I went to the state of Texas. I registered an entity. I filed this form with the IRS that magically made me an S Corp. And like you said, what that means is that I can earn money. It's a pass-through entity, so I pay the tax when I earn the money, regardless of whether I distribute the money. But yeah, in the 2010s, they came in and started even upping Medicare and FICA and FUTA from where they were, and they made that 3.8% that goes forever out there. And so, yeah, what an S corp allows folks to do is optimize for payroll taxes and then optimize for QBI, which is something we'll definitely get into later as well.
And so the way I understand this is the money passes through to the business owner in one of two ways. A W-2, which is payroll, and that includes 13, 14, 15% take in there for Medicare, Medicaid.
15.3, maybe. Yep.
Yeah, 15.3%. That's kind of off the top, and payroll taxes. That's if you pay yourself through W-2. But what an S corp is, it's an LLC that's elected in a way that passes. And I'm going to kind of try to explain this simply. This is what we're going to do all day. We're going to go back and forth. I'm going to try to explain it really simply, and you're going to correct me where I'm wrong. I'll play the small business owner dummy.
Love it.
I set up an S corp, and that's just an LLC. That means all the income from that LLC it's passing directly to my personal tax return, passes right through to me. So all the income counts as my income, but it's not necessarily W-2 payroll income. It's small business income. So therefore I can save that 15.2% FICA. And if I'm doing work for people, and maybe there's 3 or 4 clients that I'm doing work for on the side, for step one is set up that S corp so that I'm not taxed as an employee for all that money that I'm making with these different businesses.
That's right. Because if you don't set up the S corp and you just had this disregarded entity, whether it's an LLC or you're just out there doing business in your own name, you're going to file a Schedule C. And at the bottom line of that, every dollar up to 150 is just going to, or 160 out there today is just going to be taxed at that 15.3%. And so, what I always explain it in this concept of like, you're buying a franchise. Your business is a McDonald's and you are the owner of that franchise. So you took the risk, you built the building, you entered into the lease, you constructed it, you put all the systems in place. And that's the owner portion of what you do. But you also run the drive-through window and you run the cash register. So like, you are the employee. You show up into your business every day, but you also hopefully built a business around you that derives more value than what you would command in the marketplace. And so you're supposed to set a salary for yourself that is, in effect, what you would pay somebody else to do your day-to-day job. And so the arbitrage there is for like a psychotherapist who goes into private practice for themselves and was making $70,000 working for a not-for-profit or working for a mental health hospital, and now they're charging $300 an hour and raking these big dollars in, and you just still say, hey, the going salary for a therapist is $75,000. Don't pay self-employment tax on $220,000. Pay self-employment tax on $75,000. So
beautiful. Yeah, there it is.
Yep.
All right. So let's go to number 2, QBI optimization.
Awesome. So I touched on this a second ago because salary is a component of it. But in 2017, Tax Jobs Act gets passed. We're pumped because of bonus, but another thing happened, or a couple of other things. They lowered the corporate tax rate to 21% flat tax. If you own a C Corp, you now pay 21% tax. And so they threw a bone to the small business tax owner with this QBI deduction out there. So qualified business income, QBI, is basically the net income of a small business. And, there is now a 20% automatic deduction on that small business income. So, I make $1 million. Well, now I have a $200,000 deduction out there. But there were a couple of, big time. And so, this works for real estate. It works for,
let's say there's a plumbing company with 5 crews and they have $1 million of EBITDA.
Perfect example.
The business owner, one business owner, S Corp. You're saying that at the end of the year, after he pays all of his expenses, he's got $1 million left of EBITDA, and out of nowhere he can get QBI, which is 21%, and write it off as a
20% deduction. Yep. Mm-hmm. So if you go look at Form 1040 and you pull it up, there's a sweet line on it that says QBI deduction. And yeah, you calculate that, and that it's line 13, qualified business income deduction from Form 8995. And so that's a 20% deduction, but there are qualifiers. So there's something called the SSTB, a specialty service trader business. I am one of those. I'm an accountant. If you're a lawyer, a doctor, other certain kind of like white collar jobs, certain engineering firms, certain, also if you're famous, if you're like a musician, if you're Taylor Swift and you're trading on your own likeness, you become ineligible to take QBI on that portion of your income. Especially it phases out at $400,000, let's just say, of taxable income for the taxpayer. So when I hit $400,000 of taxable income, I phase out, and basically by about $500,000 of taxable income, I'm totally phased out. I can't take QBI because I'm on the accounting business that I run, because I'm a specialty service trade business.
Okay,
but this plumbing firm that you talked about, they are not a specialty service trade business. So they can run it up. I mean, that plumbing firm could have $20 million of taxable income and have a, $4 million QBI deduction, but it is limited by either the property that the business owns to about, I think, 2.5% of the net value of the property the business owns, which that's a ton of freaking property, 4 million at 2%. Or, and this is more often kind of what we qualify a business on, is 50% of the wages the business pays. So that $20 million EBITDA business, let's just say it had 3 million of wages. So it would have made 23 million if it paid no wages. So it would be limited to 1.5 million of QBI deduction. But you go, well, that sucks because they could get 4 million, but they're only getting 1.5. So enter this little kind of algebra equation where you add back the wages and you go, well, without the wages, it would be 23. And you multiply by 2 divided by 7, and you realize this optimal wage number, you stop laughing, is $6.5 million. So then the owner goes in and says, well, okay, I'm going to give myself a $3.5 million bonus. Who cares about playing poor? Now I'm going to play rich. And so that's a huge, thing about planning, is you just have to know, what are you optimizing for? Are you optimizing to be poor or to be rich? And you optimize for poor up until this threshold, and then you just like totally turn the other way. That's an aside, but
what's a potential red flag? It sounds like QBI needs to be optimized by somebody who's good at this. And if your CPA is not good at this, you could be leaving 10, 20, hundreds of thousands of dollars on the sideline. What are some,
in this
what's an example of just one red flag of where, if you're a business owner and your CPA doesn't ask this or doesn't do that, you need to get another opinion?
I mean, QBI is a huge example of like, and in one of my threads, I explain kind of where on that Form 8995 you look and you figure out if you optimized QBI or if you were limited by the wages your business paid. And I've gotten more clients through this one neat trick of just going like, hey, if you had just given yourself a $3.5 million bonus at the end of the year, we would have been able to deduct another $2 million. So you technically paid $700,000 of tax that you didn't need to. And like, you see it often. One of my clients, we do the work for 2 of the partners. The other partner was getting his work done locally. He sends me the tax return. I'm going, she didn't do it right. Here's how you fix it. And, it gets fixed. So this is one of the juiciest examples of the kind of checklist that we look for when new clients come in.
Okay. I just posted a link. I found your thread. It was December 1st.
Awesome.
December 21st, 2021. QBI optimization is a massive ROI project that no one talks enough about for high income earners. And I put if you're watching this after the recording, in the show notes, first link will be that linked about QBI. But
Awesome.
That's excellent. Okay, we just saved a lot of people a lot of money already. Tuning into this thing, we have 251 people live. Well, let's go on to number 3, which is bonus depreciation. This is if in small business that happens to own real estate. Okay, most real estate investors understand what bonus depreciation is. A lot of small business owners do not. And if you run a brick and mortar business or any kind of business that needs a warehouse, that needs a building, that has an office, and you own that building, that you buy that building, there's something called bonus depreciation. I'll explain it now. Mitchell, you can elaborate on this. But basically, there's a depreciation schedule for any asset that has a longer than 1, 2, 3 year lifespan. And real estate, and commercial real estate, often has a 39-year lifespan. And so you can straight line depreciate it. Not you factor out the land value, straight line depreciate that purchase price over 39 years. It's a little over 2% a year of that purchase price that you get to write off. If you buy $1 million building for your small business, you're writing off $22,000 a year as a depreciation expense. That can offset your business income, which is awesome. Now, there's a rule in the tax code, again, 2017 Tax Cuts and Jobs Act, that allows a big chunk of that building value to be depreciated quicker. That's called bonus depreciation. Well, it already can be depreciated quicker, but bonus depreciation brings it all to the very first year. So a building like this house that I'm in, the windows, they maybe only have a 5-year or 15-year lifespan. The sidewalks, the ground improvements outside, we put a dollar value on those. It might only have a 10-year lifespan. There's a 5-year lifespan on my deck, my HVAC, it's all different lifespans. So you get what's called a cost segregation study. They break out the values of the real estate that you bought, and they assign dollar values to it. Now, when they assign dollar values to it, all that 15-year and under lifespan stuff gets bunched and depreciated all in year 1. And for many asset classes, I'm in the self-storage business. We buy a self-storage building. It can be 20 to 30% of the purchase price of the asset that can be deducted year 1. We buy $1 million building. We might put $300,000 down to buy it. The bank's going to finance the other $700,000. 30% of the purchase price is $300,000. That means I'm buying a building for $300,000. That's an asset, and I'm getting a $300,000 deduction back year 1. Now, there is recapture, and your basis drops. So when you sell, you'll have a difference in between, which is called recapture. You'll have capital gains on that stuff as well. And there's different types of income. We can go really in the weeds here. Consult your own CPA and read about this stuff online. We can't possibly cover everything about bonus depreciation in the next 3 minutes that we're going to talk about it, but it allows business owners who buy real estate to get massive deductions year 1. That's where, Mitchell, you own a firm called RE Cost Seg. They can do virtual. We're not going to spend a lot of time selling that service right here on this call, but if you go to recostseg.com and you recently bought a building, they'll do a virtual tour. They'll provide you a report, which is basically a deduction schedule for that business, and you can get massive deductions that can offset your business income, or if you're a real estate professional, even your active W-2 income.
Yeah, and someone asked, can I do that for a property I bought a few years ago? You certainly can. And so, the one, out of RE Cost Seg, we wrote this thread called the STR loophole. And the problem with cost segregation and bonus depreciation for most folks is if you aren't a real estate pro, you cannot offset active income with passive losses. So you cannot use that bonus depreciation to lower your W-2 income out there. And, so we wrote this thread about enter the short-term loophole. So, folks who run Airbnbs or properties that average less than 7 days stays, they don't technically have rental income. They're running a business that happens to own some property. And so that thread kind of carries over to not just Airbnbs, it carries over to every small business there is, where if I'm a dentist's office or a lawyer's office, or that's the way to think about it, is
if the business owns real estate to execute its core function, then that real estate depreciation can offset the income from that business, which can be a beautiful thing. So if let's just give an example here. You run a business that operates out of a warehouse. You buy the warehouse for $1 million.
Yep.
Every year your business makes $500,000 of income, and year 1 you pay a couple grand, you get a cost segregation study done through recostseg.com. You get your deduction, and you get a $250,000 deduction year 1. That means the year you buy your building, half of your income can be basically depreciated and deferred into the future. The taxes can be deferred to the future. That's a beautiful thing.
Yep. So yeah, this idea of, and bonus depreciation doesn't just exist for real property. I mean, like I have a client who's a physician, who's a dermatologist, and he's going, "Hey, what do I do to?" He came to me and he goes, "Are there deals that doctors can invest in that like will lower our taxes?" And I was like, "Yeah, there's actually an entire industry built on selling doctors terrible deals that will lower your taxes because you'll lose all your money. So let's not do that." But like, if you're a derm or you're a certain type of physician and you're going to go open up your own office and buy tables and buy equipment and either buy your own building, which this guy did, or, even rent some space, you're going to go be able to buy lasers and buy kind of equipment that, although the value is going to go to zero, it's not real estate, it's not really worth anything, but it will be cash flow positive. You will go generate money by owning this equipment. It'll build the moat for you. It'll make your business better. And so like at the end of the year, or, if you're a roofer, you'd go buy a forklift and a Chevy Tahoe in December, or a, big old Silverado pickup truck or whatever. But if you're this guy, you start thinking about, hey, what's the next foray of equipment that I can install into my office that's sizable, that I can finance, that I can get a deduction for today and pay for over time and generate positive yield, right?
Yep. I love it. Section 179 and car mileage are two. This is the next one. Section 179 is very, very similar to bonus depreciation. I'll explain this as succinctly as possible. You correct me, Mitchell. If I'm going to buy a vehicle that's over 6,000 pounds and it's going to be used for my business, which means cargo van, truck, bulldozer, tractor trailer, any thing on wheels, I can deduct the entire purchase price the first year that I buy this asset. That means if I'm a salesperson and I'm a 1099 salesperson and I have a lot of clients that I see and I get paid by 1099, which like you set up an S corp, you avoid those payroll taxes that way. And you need to buy a vehicle to drive around to do all your calling. And it's also going to be a fully loaded Escalade that weighs 6,700 pounds, $120,000. You buy that vehicle. Maybe you only put $20,000-$30,000 down on it, and you get a full $100,000+ deduction year one on your taxes when you buy that vehicle to run your business through. Now, I don't necessarily recommend buying a $120,000 Escalade to do business, but this is a way that some people and contractors, it's a blessing and a curse, because I see so many contractors at the end of the year, they got a lot of income and their CPAs tell them, go buy something. And they go buy a brand new freaking F-250 Platinum fully loaded for $120,000 that they didn't need, all to lower their taxes. So your advice back in the, many times, Mitchell, when we're talking about this stuff is don't let, the tax tail wag the income dog. You know what I mean? Don't let your tax strategy fully dictate what you do here. Putting money in the bank and paying taxes on it is paramount. But if you're going to buy a vehicle, and if it weighs 600,000 pounds or 6,000 pounds plus, and if your business needs it, Section 179 allows you to deduct the whole thing. This applies to tractors, for agriculture. It requires of hauling vehicles, trailers, all equipment. So Section 179 is a massive advantage.
Well, and bonus applies for 6,000 pound cars too. There's specifically a carve out for passenger vehicles below 6,000 pounds. So that's why we talk about 6,000 pounds. There's no reason a car wouldn't be deductible, except that Congress went and said, hey, if it's a passenger vehicle below 6,000 pounds, you can't bonus it. You can't 179 it. So then, we invented Chevy Tahoes and Ford F-150s and,
even
now
Teslas.
and big old heavy battery Teslas. And so, totally, don't go. There's the old like gross sarcastic accountant joke of like, hey, I could just quadruple my fees, or like you can invent enough expenses in your business that you don't need to reduce your taxes to zero. But sometimes it's better to just pay taxes.
Guy runs a lawn care company and says, what about my lawn equipment that's under 6,000 pounds, like my lawnmowers and things like that?
Yeah. So that's what I'm talking about is all machinery and equipment is eligible for bonus, is eligible for 179. Nick, just as an aside, we're going to see a lot more 179 usage once bonus depreciation starts phasing down. We'll just go, okay, well then I'll just go 179 some stuff. So you're going to see a lot more playing around with this stuff.
And 100%
says bonus.
One person was owning a landscaping company. All their equipment can be 179. Another guy says, I own a boat charter company. Can I 179 my boat? And I think the answer to that is yes as well.
Yeah, you might be able to bonus it too. Or yeah. And then it's really 179 has some limitations of if you're putting more than a couple of $1 million of assets, or if you're trying to deduct more than $1 million, and then there's an SUV limit of $40,000. So ask your accountant whether you should bonus or 179, and there's going to be a lot of like optimization stuff around that.
And to be clear, Section 179 just speeds up the deduction, right? Vehicles they're deductible over, is it 5 years?
5 years.
Yep. Yeah. So every vehicle that you purchase is deductible over 5 years. So if you buy that $100,000 Escalade, it's going to be $20,000 a year deduction against your taxes. But Section 179 speeds it up and makes it all the deduction in year one. Or all you're doing is you're pushing the can further down the road. And when you trade in that Escalade, guess what? The trade-in value for that thing, still $70,000. That's income. That's income for you. That's capital gains.
So then you start like-kind exchanging assets that are tanking in value.
My favorite way to do this my addition is I never actually did 179. I never bought and owned a personal vehicle that was 179. Yes, we owned moving trucks, and yes, we've owned equipment, lawnmowers, but I've never Section 179 a vehicle for my family that I use for business. Okay. My method is to do mileage instead. And we can talk briefly about travel and per diem, but the government has per mileage rates that you can deduct mileage. You can give this to your employees if they're driving for you, or as a business owner, you can take a straight deduction based on how many miles you drive. So every year from year 2011 till we sold that company in 2020, I was driving a lot to all of my moving and storage companies all over the country. I'm talking, I was doing 15, 20,000 miles a year, going long road trips, 700 miles at a time to get, from Boston to Nashville, Tennessee to our branch there to run it that year. And what I would do is I would drive a 8-year-old Toyota Camry that I bought for $7,000 and it got 33 miles per gallon. And that vehicle only, it got 30 miles per gallon as well. That vehicle only cost me about 22 to 25 cents per mile to actually own and operate it. That's me owning it. That's maintenance. And that's me putting fuel in it for 22 cents a mile. But back then, now it's 62 and a half cents per mile or something along those lines. Back then it was 65 cents a mile. Back then it was 55 cents a mile. So I would drive 20,000 miles a year and it would only cost me $4,500. Okay. $4,500 in fuel, depreciation on my vehicle, all of it. That's what it would cost me. But I would keep a mileage log with the date, where I was going, beginning odometer reading, ending odometer reading, total miles, and what I did when I was there. I kept that in a giant Google sheet every single year. I would add it up. I'd have almost 20,000 miles. I would get a $10,500 deduction when my expense was only $4,500. So my vehicle was paying me back to drive it around. I didn't have the big Section 179 write-off. I didn't have the big car payment. I had a economical vehicle, and it was an amazing way for me to save money on a day-to-day basis in my small business.
So zooming out, there's two ways you can deduct a car. You can take actual expense, which unlocks 179 bonus, and then you get to deduct your oil changes and your tires and your, the gas you put in the car. Or like Nick chose to do, you can just take the 65 and a half cents a mile that the government gives you in 2023. And I had a good story.
A clarification here is if you take the mileage per diem, if you take the mileage per mile deduction, you cannot write off your fuel and you cannot Section 179 your vehicle. Okay. You pay for your own fuel. I paid for my own fuel on my personal credit card. And then I wrote off the mileage in my car. Okay. That's a big difference. And you can't deduct the mileage that's not business mileage. If you're going to church with your family, if you're going to the grocery store with your family, those are not deductible miles. I had to keep a mileage log, very accurate, of where I was driving, how far I was going, and what it was for.
And you can't flip back and forth there. You can't bonus it and then go decide you're going to start doing miles. I had a good friend of mine who his parents bought him a car, going off to college. He kept it for 6 years. He went out into the oil fields and was an oil landman and made $100 a day rate or whatever, and was just driving all around the world. And he was driving his 2001 Scion with duct tape on it, and everyone made fun of him. And he just said, listen, you make $100 a day. I make $130 a day because I drive this piece of shit car around and it costs me nothing. So
it cost him 10 cents a mile to drive it, and
he was making
48 cents. Yeah.
Yep. They were paying him. They were paying him for the mileage. It's beautiful.
Yep.
So it's a cash cow.
Love it. Let's move on. The mega backdoor Roth. Quickly, what is this one, Mitchell?
Yeah. So, back to the benefits of going into business on your own. Now you can define your own comp plan, and you can define, I'm going to pay myself 75 grand a year or whatever. If I'm the only employee in this business, I can then start to design the most Cadillac retirement plan that's ever existed. And one thing that folks don't know about is, we all think the 401k max is $20,000 or whatever. It's not. It's it's 60,000, or it's 22.5 today, but the real limit is 62.5 or something. So the employee can defer 22.5, and then the company can match the rest out there. And so if you're the only employee in the company, you can say, hey, my employee that makes $75,000, a big part of their comp plan is that we match the max, which is either 40K or 25% of the salary. And so we're going to say they're going to defer 22.5, and we're going to go ahead and match, whatever 25% of 75 is.
So that's the way your employees can earn more money with less of it being taxable. It's basically a perk for your employees. You want to find a way to get one of your employees, let's say $100,000. You want to find a way. This can be a way where, hey, I'm going to get them 100 grand, but they're going to get to keep more of it because more of it's going into this Roth that's tax deferred. And Roth means you're putting pre-tax money in, and you don't pay taxes on it until it's already grown for 20, 30 years and you're 65 and you've retired.
Yep. So you can do a solo 401k and do it all tax deferred. And then there's this idea of the mega backdoor Roth where none of it's tax deferred and it all rolls forever. You can self-direct these things. Once you get multiple employees, these things start to break down because they don't want the doctors to all have one retirement plan and the nurses to have another. They don't want me to give myself this Cadillac insurance and me give you, bottom of the barrel. So, but I have a lot of clients who make a lot of money, who have no employees, who just work by themselves. And, you get to play a lot of games around this. So,
back when we were in the storage business, we did a SEP IRA. And if we gave all of our employees an option, and then they had the option to either opt in or opt out, then even we as business owners could put up to $22,000 a year into a tax deferred account. And that was the deduction for the business, but it was not income for me as a business owner. And that was a huge win.
Yeah. And so there's, this is mega backdoor Roth is one thing, but this is just a big flag for when you go into business for yourself, you can look at defined benefit pension plans, which allow you to put hundreds of thousands of dollars away. You can look at,
what's the education one for your kids?
Yeah. The 529, that's separate, and anyone can do that. But that's a tougher deal because you only have 18 years to compound.
Basically, the government here has given business owners a way to get their employees. They're trying to get more people to save for retirement, and they're incentivizing the investment in our equities and our funds. So they're going to give people tax advantages to invest capital into their retirement accounts because they want people to have money when they retire, and you are going to get a lot of tax benefits by doing that. It's a beautiful thing.
That's it.
All right, let's talk about ERC and what happened during the pandemic and some of the tax codes that came out after that. We can also talk about one of our title sponsors of this webinar, which is the Tax Credit Hunter.
Yep. So ERC, they shut the world down. Businesses just go into hibernation. Employees have no idea. They come out quickly with PPP loans. They come out with PPP2. Bunch of people did those. Bunch of people didn't. The banks are all scrambling. kind of a little more quiet. And now it's not so quiet because everyone's getting text messages and emails and phone calls every day about these things. So the cat's out of the bag here. But
let's explain. Let's explain what it is. So ERC is an employee retention tax credit, and for businesses that had more than 5 employees, and they could show in some way or manner that their business was affected by the pandemic and the lockdowns. If their business was affected, and you can make an argument several different ways, and you have more than 5 employees, you get a credit, which is how much money?
It depends, but yeah. And 5 employees is not a hard line. It's just hard to like economically qualify for these things and deal with them. But really, businesses that they basically took 2019 as the baseline year. And they said, hey, before this whole pandemic mess, you were making $1 million a quarter. Well, if any quarter in 2020, your revenue reduced 50% quarter over quarter compared to 19, you qualify, and you qualify for that quarter and the next quarter. And in 2021, if your business went down by 20%, relative to still that 19 original set period, you qualify for that period. And so, you get $5,000 per quarter per employee in 2020, and then 7 in 2021. And so it really,
per quarter per employee. So if you have 10 employees and they worked all 4 quarters in 2021 and all 4 quarters in 2022, you're entitled to
50% of the qualified wages up to $5K. And so, I mean, that's pretty, it adds up pretty quick, especially when you go look at franchises and, Chick-fil-A's and Snippets haircuts and all of those things.
Even a local business with 5 or 10 employees, and they kept them on board, and they had a quarter where it was slow, right when everything was locked down, and then and the world opened back up. They could be entitled to tens or twenties of thousands of dollars through these employee retention tax credits. And this is a credit. Again, this is a credit that it can be traded for money, and B, it's equal to paying taxes with. So if you get $100,000 credit, you've seen businesses with like 9 or 10 employees that got almost $100,000 credit. That's basically cash in your pocket, which is a pretty incredible bonus. And almost all employees almost all companies took PPP, but not many have actually.
There's billions and billions of dollars sitting out there. And so there's one other way to qualify other than the revenue drop, which is you were mandate shut down. You couldn't walk into your office and you couldn't conduct business. And that's not, hey, we were all a startup and, we were all remote anyway, and we sell fairy dust online. That was, we go to the office, we ran a daycare, and daycares were shut down. And then one other idea is the startup retention credit. It's for businesses that started in 2021, or they started after February 15, 2020, and they had less than $1 million in gross receipts on a 12-month run rate for 20 and 21. And that's one that kind of not everybody knows about, and that all of the wages you pay, $5,000 per employee, up to 50% of the wages paid. So thinking about this, there's a bunch of unclaimed money. You have some more time to go start claiming these things. And, a lot of people didn't claim it because they didn't know they could or didn't think it was right. And, I just told my clients, hey, take the money. If you need the money, you're not going to be able to get it. It takes time. You don't know what's going to happen. This world's a confusing place. You can always pay the money back. So
you can, as a small business owner, you can go to taxcredithunter.com, click on the little button, put a couple things about your business, and you get a free proposal from them that outlines the fees, how much expected tax credits available. And you work with Chris Gumison, who's a good friend of ours and a trusted CPA to run the tax credit work. And also Tax Credit Hunter does R&D and 45L. So from what I understand it, R&D is a research and development credit where if you are spending money on innovation inside of your business, whether it be software, processes, you're paying wages to people who are trying to innovate your product, your service inside of your company, a certain percentage of their salaries that you pay them, or the expenses that you spend on R&D, can be used to claim a tax credit, an R&D tax credit. And some of our friends, some of our close friends who we both know, have businesses with, anywhere from 10 employees to 200 employees, and they've seen, significant R&D tax credits every year, where we're talking $50,000 plus of R&D money that's coming back from the government as a subsidy to you for innovating as a small business. And large companies like Apple, we're talking their R&D credit is in the billions of dollars. Like the US government subsidizes billions of dollars of innovation inside these companies. So if your small business is spending money on software, processes, new products, innovation, you're spending time, you're spending energy on this stuff, an R&D tax credit is very, very realistic for your business.
Very true. So yeah, it has to be a qualified research expense, technological in nature. There needs to be a business case for it. There has to be technical uncertainty, and there has to be this process of experimentation. What Tax Credit Hunter does is they will interview your employees. They will kind of build a bulletproof case and calculate your credit for you and give you a nice slick report that you can hand to your accountant. Call the credit 7% of the wages. So for every 100,000 of QREs, whether they be wages or supplies or software or, system setup. Yeah. So 7,000 per 100,000 is given back to you, monetized again, dollar for dollar against taxes that you're paying. So it can be massive.
Beautiful thing. TaxCreditHunter.com for that. 45L, talk about it very briefly. If you're developing or remodeling multifamily housing, and you're adding energy efficient, generally sometimes just up to code appliances, windows, insulation, you could be eligible for a 45L tax credit, which is $2,600 per unit, or what is it?
$2,500. Yeah.
$2,500 per unit of free money.
You say, or it was 2,000, I'm sorry, last year, and it's 5,000 this year, but there's some additional requirements as of 1/1/23, but they're really expanding the credit. Like, this is the new vector of tax credits in America. And you said multifamily, it's also for single family home builders who, develop a volume of these, but it's, going back to 1/1/23, $2,000. And we've done a lot of these where, where we did a 518 unit complex where they got $1 million in credits. They had high performing heat pump, heating and cooling. But really, to your point, if you're building in California, the code in California is higher than the requirements of what it takes to meet this 45L. And
most developers meet those requirements anyway if they're building quality construction. So that's pretty awesome opportunity. All right, great. So number 7. Donor advised funds. What is that, Mitchell?
Oh, that's a good little tax hack. And it applies for business owners in the sense that if you have valued stock, you can go donate your stock. You can go donate appreciated stock, whether it's your own stock for your own private or public business, or if I bought Apple for $100 and now it's worth $1,000, and I have a $900 built-in gain. If I go sell that stock, I'm going to get hit with 23.8 plus state taxes to realize the cash to go hand it to my church. And so what folks do, and what the tax code gives us, is this opportunity that instead of selling the stock, paying the tax, and donating the $600 I have left, I can gift the entire stock to the not-for-profit at fair market value today and never pay tax on the kind of underlying gains. So it's this double dip out there of how
hard is it logistically? How hard is it logistically? You have some stock, your equity in your brokerage account. Can your brokerage help you do this, or how can you transfer these things without selling them?
Yeah, so big organizations should have a program where if you contact their gifting and they're going to have some threshold, like they're going to go, hey, is this $400 or is this $20,000? Because if it's 20 grand, we want it because we want to go, put a new roof on. And so you go, hey, I have $20,000 of Apple stock. Tell me your brokerage instructions, and I'm going to go call Fidelity and just tell them to wire that stock over to you.
Yeah,
the other thing is
I attend a gala, a banquet every winter for not for profit in Athens. It helps special needs kids, and they raise a ton of money. They raise millions of dollars, and a lot of small business owners in town, or just wealthy people who have stock. They own stock in companies, whether it be Microsoft, Google, Ford, anything. They own stock, and they've held this stock for a long period of time. They might want to give $5, $10, $20, $50,000 to a charity each year, maybe their church, maybe a charity. They're actually going to just gift the stock so that they don't have to sell it. And then as soon as the not-for-profit gets the stock, they can sell it, but it's not a taxable event because they're not taxed as a for-profit company. So it's an amazing way to give money without selling stock for liquidity and paying a huge tax bill on it. It's an amazing hack. Everybody should do that.
If you just 20x'd in NVIDIA or whatever, you can give that away and find a charity that's willing to take it, get the deduction at par, and you can just go buy the stock back. Like, you know, like the holy hell. So, and so then we were talking about a DAF, a deferred account. And that's another, there's this concept of, well, I had a big exit this year. I had a big liquidity event. I have millions of dollars. I'm at the top tax rate. This is the biggest income year of my life. And I know I'm charitably minded, but I do not have the charity targeted that I want to give the money to, or the charity that I want to give the money to is not ready to take the money right now. You can use these deferred giving plans. Every one of the big brokers has one, Fidelity, Schwab, blah, 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 Vanguard, where you can effectively gift the money to the Vanguard Charitable Trust. They will earmark the money for you, and they will kind of give you coupons and let you, do your own giving program where you just don't have to, that charity that you love in Athens, they're ready to take $2 million. They may not be ready to take $10 million, or maybe not $10 million from you. So you get to just buy yourself time. You get to stay invested in the market, but get the deduction this year and then allocate the funds to your charity of choice over the next 20 years. So
beautiful thing. Okay. If you're listening, you have any questions, type them. We're going to answer maybe one more here, and then we're going to cover one more tax hack, and then we're going to answer some questions. So post them over in the Q&A. I'll follow it while Mitchell explains to us number 8, which is the Augusta Rule. I have a friend who lives in Augusta. He works with me, plays in golf tournaments with me. He rents his house for 1 week, 10 days in Augusta, and makes $20,000 renting it to corporations for Masters Week. The U.S. government has a 14-day tax-free rule for renting out your primary residence. Mitchell, how does that work?
Yeah. I mean, you just explained it. So you can rent out your primary residence for 14 days and exclude the income, meaning you don't have to justify that you paid, the maid to clean up, or you paid the taxes, or you paid the utilities. It's just nothing. It's just off the top. So a lot of people do this the honest, practical way, like your guy, which is just, hey, I'm going to move out of my house for 2 weeks. I'm going to go to my beach house. The golf tournament's coming in, and we're going to rent to Rory McIlroy's grandma. And then, the other people kind of play around with this and use this where, hey, I'm going to just rent my house to my business to host parties. And here it's a deduction to my business and income to me. So that's the tax hack. That's the fun way to do it. You just better have your ducks in a row when you're ready to do that. But the one I want to talk about before we go is the SALT cap workarounds. We need to discuss that. It should have been higher. It's just, so state and local taxes, when Tax Cuts Jobs Act came in, you used to be able to deduct them all on Schedule A of your tax return. They limited it to $10,000. So people in blue states with high taxes went ballistic, right?
What's SALT? And so what's SALT, Mitchell?
State and local tax. So when
there's federal tax, which is the 30 to 40% tax bracket range, but then there's state and local tax, which California's 13%, Georgia's 6%, and Florida's 0%. But there's two, basically, it's tax on income, right? Okay.
Yep. So I pay 37% top tax rate to the federal government. I pay 13% top tax rate to California. That puts me at 50 cents, right? Well, if I pay, you know, 370 grand to the federal government, that's not deductible. Like you don't get to deduct the taxes you pay. Well, you used to be able for federal taxes to deduct the state income taxes you paid. So that 130 grand you were paying to California, you'd get a write-off on Schedule A. Well, they changed the rules around because the federal government was doing all these tax breaks, and the red guys were going against the blue guys. The blue states have more state income taxes. So they said, well, we're going to put a cap on the state and local income taxes that you get to deduct. It's limited to $10,000. Well, people are living in California who are paying hundreds of thousands of dollars of income taxes to California. They started to build this workaround where the state basically said, hey, you can just go ahead and expense this on your business as a deduction. You can pay us the taxes, and we're going to call it a deductible business expense out there. And so folks have figured out all these convoluted ways in New York and California and a few different states how to take their state income taxes, effectively prepay them, and deduct your state income tax as a business expense. So it varies state by state how you do it. But if you live in a high tax state and you're a big dollar earner, you ought to be looking at it. So business or succession planning, there's a lot of ways to think about business and succession planning. I wrote a pretty long Twitter thread about that. It's just about ways to think about it. There's the idea of selling your assets versus selling your stock, and there can definitely be some considerations around that. Asset sales open up into play the idea that you could go bonus depreciate, get a second bite at the apple of bonus depreciating, but then it also creates recapture on the other side. Rashawn says, what's the best way to pay yourself monthly from a business that's just getting started? Salary, partner distributions, guaranteed distributions. If you just started a business that's making enough money that you can pay yourself, that's awesome. You can distribute to a certain extent, but again, back to this, what's a appropriate salary question? Like the IRS doesn't want to see that you just paid a ton of distributions to yourself and never paid yourself an appropriate salary at all. Those distributions can just all get reclassed to salary. So, distribute to yourself for a little while, but at a certain point, you're going to need to decide an appropriate rate to pay yourself. How are distributions taxed, and are distributions and owner's draw the same thing? From an S corp, you're taxed when you earn the money, not when you distribute the money. So eventually you're going to have to distribute money, because if you earn millions of dollars and you incur all these taxes and you never make a distribution, you're eventually just going to kind of run into this personal cash crunch. So again, with an S corp, you're taxed when you earn the money. You're free to distribute all the taxable income whenever you'd like. So we're going to make a video, or we're going to make this video available. We'll send it to you in the next couple of days. And along with that, we'll send you some more information. Again, this was brought to you by Tax Credit Hunter. It was also brought to you by Better Bookkeeping. Better Bookkeeping is a platform that I've built over the last couple of years. It's a bookkeeping agency. We do all of your books for you, and we do a lot of S corp and individual tax returns. Go to betterbookkeeping.com to learn more about it, and we'll send you some more info about that as well. So with that, hey, I appreciate y'all guys. We're kind of running out of time over here, so I'm gonna sign off, and thanks again. Take care.
Big news, guys. I created a free PDF that details my method on how I analyze a self-storage facility and figure out what it's worth. Give me a pen, the back of a napkin, and a couple metrics, and I can figure out about what the property is going to be worth to me. If you want to download this PDF, click in the show notes, the first link, and you can give me your email address and you get a email right away with a 4-page PDF that outlines exactly how I think about underwriting or giving my initial analysis on a self-storage facility. Again, click the link in the show notes and you're going to get that document for free. Before you go, we have a new sponsor of the show, recostseg.com. And if you bought a piece of real estate, you need to get a cost segregation study done. It's what allows you to get all that sweet, sweet bonus depreciation, and it's how real estate investors like me and many others pay almost nothing in taxes on an annual basis. You can cost seg a single family rental, a short-term rental, or a large commercial property. recostseg.com is affordable and aggressive and super fast to turn them around. They've done 10 plus cost segs for me this year. They're going to do many more for me. Visit recostseg.com to learn more.